Picture this. You wake up tomorrow and every headline says the same thing. Banks are under stress. Not one bank, not two. All of them. Analysts are arguing on TV, social media is screaming bank run, and your group chats are suddenly full of people asking the same question. Should I pull my money out? But here's the part that doesn't make sense. If banks are failing, why does everything still look normal? The ATM still works. Your card still taps. Salaries still hit accounts. The lights stay on. It's like the system is wearing a calm mask while something underneath is cracking. So, what's actually happening behind the scenes? Because a bank doesn't survive on cash the way people imagine. It survives on belief. And when belief starts to wobble, something else steps in, quietly, urgently, sometimes overnight, to keep the whole thing from collapsing in public. That's the mystery. Who keeps banks alive when the math stops working? Who provides the invisible oxygen when confidence runs out? And once you see the answer, you'll realize the scariest part isn't that banks can fail. It's that the rescue plan can change the entire economy without you noticing until it's too late. Number 1, the illusion of stability. Banks have always been built on a paradox. They project absolute strength while depending entirely on fragility. The foundation of modern banking isn't gold, vaults, or even the physical cash people imagine. It's confidence, the invisible currency that keeps money moving. Every deposit, every transfer, every investment exists because millions of people collectively believe their money is safe. But behind that belief lies a risky transformation process. Banks borrow short-term from depositors and lend long-term through mortgages and loans. This mismatch is the system's original flaw, baked into its DNA since the first modern banks appeared in 17th century Europe. When people lose confidence and demand their money back all at once, the system cracks. The walls of marble and steel mean nothing when the foundation is built on faith alone. History has shown it repeatedly. A rumor, a headline, a whisper of doubt can start a chain reaction powerful enough to take down giants. Governments learned this lesson the hard way. Every major panic, from the Great Depression in 1929 to the global crisis in 2008, forced leaders to create new safety nets. Deposit insurance, emergency lending windows, and central bank interventions were introduced not out of charity, but necessity. Each one was designed to stop the stampede before it started. The Federal Deposit Insurance Corporation, or FDIC, guaranteed depositors that even if their bank collapsed, their money would not disappear. Central banks became lenders of last resort, providing emergency liquidity when interbank lending froze. These tools didn't solve fragility, they simply disguised it behind regulation and reassurance. The system was re-engineered to survive panic, not prevent it. In essence, banks became performers on a stage built to look unshakable, with the government quietly running the lighting and sound behind the curtain. Today, that illusion still stands, stronger and more complex than ever. The same mechanisms that saved the past crises now operate automatically, often without public awareness. When a bank wobbles, it's not saved by heroics, but by switches, digital transfers, hidden guarantees, and emergency liquidity pipelines activated overnight. The public sees stability, but insiders know the truth. Survival depends on constant management of fear. The system hasn't eliminated the danger of collapse. It has merely perfected the art of delaying it, and every time the curtain rises again, the audience claps, unaware that the entire show only continues, because the illusion never stops being maintained. Number 2, the hidden engine behind every rescue. When a bank begins to stumble, the savior rarely appears on the front page. The true rescuer operates quietly, deep within the central bank's balance sheet. Behind every modern bailout, merger, or liquidity injection lies a single entity capable of creating money from nothing, the central bank. Its role as the lender of last resort wasn't born from generosity, but from survival. During financial stress, banks stop lending to each other because they fear one another's insolvency. That's when the central bank steps in, exchanging cash for collateral, no questions asked. These emergency operations keep the bloodstream of the economy flowing, even when the organs are failing. But here's the catch. Every rescue dilutes accountability. Once institutions know there's always a safety net, the incentive to act responsibly fades. What was designed as a temporary measure becomes a permanent dependency, a silent addiction that no one wants to admit exists. The system's evolution into dependence began after 2008. The financial crisis revealed how intertwined banks, hedge funds, and governments truly were. Massive institutions were on the verge of collapse, their balance sheets filled with toxic assets that couldn't be sold. The Federal Reserve, the European Central Bank, and others responded by launching unprecedented programs, buying bonds, guaranteeing liabilities, and flooding markets with liquidity. These interventions worked, but they also rewired the system's DNA. Risk was no longer punished, it was restructured. When interest rates rose again years later, those same banks found themselves holding huge unrealized losses. Once more, backstops appeared overnight. not to solve the problem, but to mask it. Each new rescue tool became a part of a growing arsenal designed to prevent visible failure while the underlying weakness deepened. Today, this hidden engine powers global finance. Every credit card swipe, mortgage approval, or stock transaction indirectly relies on a network of guarantees and emergency levers built to sustain faith. The irony is that most people think banks create stability, when, in reality, the stability comes from the invisible safety architecture around them. The central bank doesn't just manage money, it manages emotion. The belief that tomorrow's system will function like today's, yet each intervention pushes the limits further, creating larger institutions and riskier behavior. The rescuer and the rescued have become indistinguishable, bound in a relationship where survival demands constant control. The system endures, but only because someone is always holding the defibrillator just off stage. Number 3, the breaking point of confidence. Every financial system reaches a moment where numbers stop mattering and psychology takes over. For banks, that moment is when depositors begin to doubt the story they've always believed, that their money is safe. The 2023 and 2024 banking tremors proved how quickly faith can evaporate. Rising interest rates slashed the value of long-term assets, leaving banks with massive paper losses. On balance sheets, they still looked solvent, but in market terms, they were bleeding quietly. The second that contradiction became public, panic spread faster than regulators could react. Within hours, depositors moved billions through mobile apps, a digital version of the old-fashioned bank run. It revealed a chilling truth. Technology had accelerated fear to light speed. The traditional tools, reassuring statements, press conferences, even deposit insurance, suddenly looked slow in a world where withdrawals could drain a bank before sunrise. Behind the scenes, emergency measures kicked in. Central banks launched rapid lending facilities, offering cash against bonds no one wanted to buy. Governments expanded deposit guarantees to calm markets. But these weren't sustainable solutions. They were emergency stitches on a deep wound. Each announcement bought time, not stability. The paradox grew louder. The more authorities reassured people, the clearer it became that the system was fragile. Markets responded with volatility, confidence flickered, and the cycle of rescue began anew. Investors realized something unsettling. Banks weren't collapsing from bad loans like in 2008, but from bad timing. Their assets were solid, their liquidity wasn't. The crisis wasn't criminal, it was structural. A design flaw that had always existed was simply exposed again under new conditions. That exposure changed the narrative. For decades, people believed that regulation, capital buffers, and oversight had made the system safe. But the cracks in 2024 showed that no law can legislate trust. Once the public senses uncertainty, no spreadsheet can erase it. Confidence, once broken, cannot be rebuilt by printing money. It must be earned back, slowly, painfully, if ever. And yet, the machine keeps running because the alternative is chaos. So the system does what it always does: patch, promise, and press forward. But every rescue leaves a scar. Every fix sets the stage for the next break. The lesson is simple but haunting. The strongest system in the world still depends on the most fragile human emotion of all: belief. Number 4, the fallout that never really ends. When the dust settles after a financial scare, the headlines fade, but the real damage lingers quietly in the background. Every rescue operation, every emergency loan, and every guarantee leaves invisible marks on the economy. Inflation pressures rise, public debt expands, and inequality deepens. The people who caused the crisis often recover first. The ordinary saver recovers last. After 2008, global debt didn't shrink. It exploded, tripling in just over a decade. Central banks, once cautious lenders, became permanent market participants, buying trillions in bonds to stabilize yields. These interventions blurred the line between free markets and managed systems. The market stopped being a mirror of value and turned into a reflection of policy. Prices no longer moved freely, they were guided. That quiet distortion became the new normal, one most people never noticed because it unfolded gradually, masked by recovery narratives and rising asset prices. The hidden cost of those rescues is a fragile dependence that deepens with every cycle. Once markets learn that intervention is guaranteed, they begin to behave differently. Risk becomes cheap. Debt becomes routine. Investors chase yield with the safety net of knowing central banks can afford to let everything crash. It's a subtle moral hazard that grows stronger with each crisis averted. Meanwhile, smaller banks and local institutions struggle to compete against the giants fortified by government and central bank protection. The very fixes meant to stabilize the system slowly reshape it, concentrating wealth and power in fewer hands. Ordinary citizens, unaware of how interconnected, these dynamics are simply feel the symptoms: higher prices, slower wage growth, and recurring financial anxiety. The system doesn't collapse, it erodes. Confidence is maintained, but fairness decays, replaced by a quiet understanding that the game isn't balanced anymore. This erosion of trust becomes the real long-term crisis. People may not run to ATMs, but they withdraw their belief in the system. They start moving money into assets outside traditional banks, cryptocurrencies, gold, real estate, even collectibles. Anything that feels less exposed to institutional risk. Governments call it speculation, but it's actually self-preservation. Each wave of instability convinces more people that stability itself is manufactured. The rescues work, but only superficially. The foundations weaken with every patch. What was once confidence becomes caution, and what was once a system built on trust becomes one maintained by intervention. The fallout isn't an explosion. It's a slow leak that never stops hissing beneath the surface of global finance. Number 5, the failed fixes we keep repeating. Every time the financial world teeters on collapse, the same playbook unfolds: emergency meetings, policy statements, liquidity injections, and endless promises of reform. Yet decades later, the headlines still echo the same fear. Why? Because the so-called solutions were never designed to remove fragility, only to postpone its consequences. After every crisis, regulators introduced new rules and capital requirements to make banks safer. But each generation of bankers finds creative ways to bend those rules. Complex derivatives replace risky loans, off-balance sheet vehicles hide leverage, and financial innovations are sold as progress while quietly amplifying risk. The structure becomes taller, more interconnected, and harder to control. Each safeguard, deposit insurance, quantitative easing, emergency lending, acts like painkillers for a system that refuses to heal. The cycle continues because the incentives never change. Profit still depends on taking risks that society silently agrees to backstop when things go wrong. When authorities intervene, they often underestimate how quickly the rescue itself reshapes behavior. Once markets realize that every failure triggers another lifeline, caution becomes optional. Investors chase returns higher, banks expand their balance sheets, and governments grow more comfortable with debt, assuming central banks will buy it if markets panic. What starts as a safety measure morphs into dependency. After 2020, with near zero interest rates and massive quantitative easing, the world witnessed the largest transfer of wealth in modern history, not through theft, but through design. Asset prices exploded, benefiting those who already owned capital, while wages stagnated. The safety net worked, but it worked unevenly. Risk became socialized, while reward remained private. The public celebrated stability without realizing it had traded long-term resilience for short-term calm. The next crisis was already growing beneath that calm, just waiting for the right trigger to expose it again. And when that trigger comes, the response will look familiar. Urgent press conferences, late-night guarantees, and new acronyms for old lifelines. Each innovation will be hailed as historic, but the core mechanics won't change. The system will once again stabilize, but weaker, more dependent, and more unequal. Real reform would mean confronting uncomfortable truths. That true stability requires limits on leverage, transparency in risk, and political courage to let failures actually fail. But history shows that such courage rarely survives the first market crash. So the cycle resets, and the illusion continues. The fixes aren't really fixes. They're pauses between repetitions of the same pattern. Number 6, the modern mirage of safety. The strangest truth about today's financial world is that it feels safer precisely because it's never been more fragile. On the surface, everything looks calm. Banks pass stress tests, balance sheets appear strong, and regulators deliver confident speeches about resilience. Yet beneath that polished surface, the structure has changed. A massive share of global credit now flows through non-bank institutions, hedge funds, private equity firms, shadow lenders, and fintech companies operating outside traditional oversight. These entities borrow short-term, lend long-term, and rely on market liquidity that can vanish overnight. The global financial web has expanded far beyond the reach of central banks, yet it still depends on them when panic spreads. The irony is undeniable. The same safety nets built to contain crisis now support an even larger, more complex system. What began as protection for depositors has evolved into a lifeline for entire markets that never asked permission to exist. The illusion of safety continues because modern crises rarely look dramatic. There are no long lines outside banks or vaults running empty. The panic now unfolds in screens, data flows, and overnight funding markets. A few billion vanishing in milliseconds, a liquidity freeze in digital trades. These are today's silent bank runs. The public sees none of it, yet feels the impact through inflation, tighter credit, and vanishing purchasing power. Governments respond the same way they always have, by expanding rescue programs, guaranteeing funds, and assuring stability. The result is a strange equilibrium where the system survives by becoming more dependent on intervention. Stability, once organic, is now synthetic. Markets have learned that volatility is temporary, that losses can be offset, and that the invisible hand of the central bank will always return when fear becomes contagious. Confidence has been replaced with conditioning. This modern mirage is powerful because it doesn't demand belief, it demands participation. You can't opt out of it easily. Your savings, mortgage, pension, and even digital payments exist inside it. Each new crisis tests how far the illusion can stretch before it breaks. Yet somehow it always holds, not because the system is strong, but because it can't be allowed to fail. Every rescue sets the stage for the next, and every promise of reform fades into memory once the markets recover. The cycle endures because it must. The banks live because they're kept alive. The question is not whether the system will fail. It is whether the world can keep pretending it won. T. Who keeps them alive? So now the mystery has an answer. Banks stay alive because modern economies can't tolerate a full stop. When confidence cracks, a hidden chain of support activates. Deposit guarantees to stop people from running, emergency lending to stop banks from freezing, and policy interventions that keep markets functioning even when the numbers look ugly. The system survives because it's built to prevent a visible collapse, even if the underlying stress doesn't disappear. But here's the unsettling part. Every rescue teaches the same lesson. Risk can be carried longer, bigger bets can be made, and the consequences can be pushed forward. That doesn't mean the system is doomed tomorrow. It means the pattern repeats until something overwhelms the tools or the public stops believing the tools will work. 3 takeaways. Banks don't run on cash. They run on confidence. The moment belief disappears, speed becomes lethal, especially in a world of instant withdrawals and viral fear. Rescues stabilize the present but can weaken the future. When intervention becomes expected, risk doesn't vanish. It migrates, often into darker corners where oversight is weaker. The danger isn't one failing bank, it's contagion. The real threat is the chain reaction through credit, jobs, pensions, and everyday payments. A warning worth sitting with. If the system can keep everyone calm, it can keep moving. But calm is not the same thing as health. The next crisis, 1T, announce itself with sirens. It will start with a small crack that spreads through the plumbing before anyone notices. If you want, the next video can break down the exact rescue sequence that usually happens in a panic. What triggers first, what gets guaranteed, and what quietly changes behind closed doors. If this made you rethink how money really works, like the video, subscribe, and comment one word. Banks, Fed, FDIC, or shadow. I'll use the top comment to pick the next deep dive.